welcome. Thank you very much for having this chat with me. Let's talk about the market sentiment. Everything is about what to expect in the future, right? The markets in this commodity field, are they exaggerating?
That's a very good question, and I like to say that commodity prices, they are usually driven by a few factors. The first one is the more micro supply and demand dynamics pertaining to each one of the commodities. The second one is the more macro, driven data and expectations coming out of those. And then the third one is more sentiment-driven financial flows, right? Right now, I do think that sentiment is dominating, right? So price action has been pretty much driven by sentiment, and there's a reason for that, right? So there has been a lot of volatility in the data flow, especially from China, coming from China because of the COVID situation. Mm-hmm. And then on top of that, there's the rising fears of a global recession. Inflation is a recurring theme. U.S., raising rates. So this whole environment just drives a higher risk aversion, and investors basically require a higher premium to buy those metals, futures, or the commodity-related equities that those producers that produce those those commodities. So, yeah.
So, leaving behind this market sentiment, mm-hmm. which do you believe would be the driver for the commodities market in the near future?
Yeah. I do think that when we look at iron ore, for example, or copper, prices have already corrected quite a bit, and I would risk to say that we may be closer to at least in the short term, 6-month view, closer to a bottom. And the fact that the price action has been dominated by sentiment basically implies that once the data flow improves at the margin, that sentiment improves as well. And that will result into higher metals prices and higher equity prices as well, right? So we think right now prices are compressed, multiples are compressed. Once we start to see an improvement in data flow coming from China, I do think that we're going to see a better environment. And one thing to remember is that, yes, there's risks and there's concern about the US, Europe going into recession, but for commodities, we have to remember that China represents 50 to 70% of demand for most commodities, right? For iron ore is around 70%, for copper is around 50%, for aluminum between 50 to 60%. So once we see an improvement in China, and we do think this will happen, and I can explain why, mm-hmm. we might even see an uplift on prices, as I mentioned.
So we are seeing the most recent data economics about China. Everything is growing, well, at least in June.
Mm-hmm. Yeah, that's true. So the latest data points were somewhat better at the margin. Not yet enough for that sentiment to improve. And on a parallel basis, the news flow regarding COVID has deteriorated in China. So we're playing with two variables here that they are clashing constantly. But once we see the data flow starting to improve, I do think that we're going to see the better sentiment. But regarding the data flow, I do think that the level of stimulus that we are seeing mm-hmm. in the Chinese economy cannot be ignored, right? We're talking about a lot of infrastructure investments already taking place, a lot of stimulus in the property market, so lower mortgage rates, more incentives towards, or less restrictions towards home buyers, tax breaks for different industries. The credit impulse, which is a number I like to look at, it's already has been on recovery mode. What is lacking, in my view, is consumer confidence, and that is tied to COVID, right? So yes. As long as we continue to see that negative news flow coming out of COVID, consumer confidence in China is going to, lag behind. So the combination of the stimulus and maybe eventually the COVID situation stabilizing, I think that could be powerful in the second half.
But China is going to be the big driver for commodities
yeah.
this semester.
China will be the big driver, right? So as I mentioned before, China is 50 to 70% of demand for commodities in general, right? Especially for metals. And we do think that not only the next 6 months, but maybe even the next 12 months, again, considering the scenario in which COVID doesn't spiral too negatively in China, we do think that the stimulus will dominate economic activity. And then we might see China going in the other direction versus the other economies. And then I think the bottom line for commodities, we're not going to go into a bull territory anymore. That's not the point. But just to give you some references, so iron ore prices, they are now trading at $100 per ton. The normal prices are like $70. So we are still at a very decent scenario. We were at 150 just 2-3 months ago. Now we're at 100, but 100 is still pretty decent, right? Copper, the same thing. We were at $10,000 a while ago, just a few months ago. Now we're closer to 7,000, but the normalized prices for copper is around 5, right? So we're still at a very decent scenario for commodities. And if China indeed recovers, we might even see an uplift from those current levels.
So landing in Latin America, what can we expect from Brazil, Chile, Peru, being these big commodity producers like copper, for example? What can we expect from these three countries in particular?
Sure. Yeah, from a Brazil perspective, iron ore is the dominant commodity, right? And we do have Vale as the dominant producer in Brazil. And as you well know, there was an accident back in 2019. And their operations were partly halted, and they have been recovering production levels since then, very gradually. So in Brazil, what we could expect is that Vale will continue to ramp up its iron ore operations. We're going to see higher supply coming out of Brazil. And they also do have some copper operations in Brazil. But I think that the focus for Brazil really will continue to be iron ore. For Peru and Chile, it's all about copper, right? So, and the political situation in these countries, as you well know, has changed over the last, in the recent past. And that, in our view, may translate into some projects being delayed, some growth projects being delayed, because there's not yet, full clarity on, how the new governments will act towards those industries. So that, in the medium to long term, could be positive for copper prices, because there's less supply coming from those two countries, which are very important for copper production. But for the companies based there, like Southern Copper, for example, we might see delays in those projects, lower value for those companies coming out of those regions. So this is our view for those three regions in a nutshell.
And for other, in the case of Brazil, in other steel and mining companies besides Vale, what are your expectations for these companies to develop in the short term?
Yeah, no, that's a great question. So as you know, it's an election year in Brazil, and the steel companies especially are way more exposed to Brazil versus Vale. Vale, they have operations in Brazil, but they don't depend on Brazilian economic activity to make money, right? But the steel makers do, right? And so now there's a rising concern about the short-term demand dynamics. But we are also more on the positive side here when we look at some specific data coming from construction activity in Brazil. It's still actually decent. The level of real estate launches over the last 6 to 12 months is now driving decent construction activity in Brazil. The auto sector, for example, has suffered from the microchip shortage. That's a global situation. But now at the margin, we're starting to see some recovery. So we're not bullish, but we do think that, at the margin, we're going to see some improvement in demand for steel in Brazil. And then regarding prices for steel, it is much more linked to what happens in China. So back to what I mentioned before, if we see that recovery in China, the reference price for steel in Brazil comes from China, so that we might see an improvement there as well. And then past the elections, I think regardless of the government, we might see decent steel demand, right? So if the government imposes a more fiscal expansion agenda with more infrastructure investments, eventually that's going to be positive. Or if there is more a focus in the domestic industries. We are looking at the scenarios from a political perspective, at least in the next 6 to 18 months, we would be on the positive side for steelmakers in Brazil.
In Mexico, we have companies besides Grupo Mexico, like Kimberly-Clark or Cemex. They are trying to protect themselves from these commodity prices. Is this a good time for them to go to hedges?
I think hedging it will depend on, of course, on the policy that each company establishes for itself. But companies that hedge within the a very volatile market scenario, they might have benefits coming out of there, right? So it's really hard to answer whether this is a good moment to hedge or not. I think hedging is about a philosophy and about a policy that you decide for your company. The controlling shareholders and the shareholders decide for their companies and approve. And once they go in that route, I think it makes sense to be very consistent on the hedging policies, and sometimes it may bear fruit, right? So that's what I think about the hedging.
Okay, and last, in a general perspective, which is your view for the metal prices in the next 12 to 18 months?
For metals prices in the next 12 to 18 months, I think we are going to see still a healthy scenario for the next 12 to 18 months. I do understand the risks related to a potential global recession, but as I mentioned before, China is the big driver here for commodities. So even if we see a deceleration in other countries, if China is accelerating at the margin, we're not going to go into a bull territory, but we might continue to see commodity prices trading at a high level. Meaning, again, iron ore prices at around $100 per ton, it's above normal. Copper prices at around $7,000 per ton, that's above normal as well. Aluminum prices, $2,500 per ton. So we might continue to see healthy price levels. There will be volatility, but our view is that in the next 12 to 18 months, commodity prices will remain at a healthy level, no longer in a bull territory, but remaining at a healthy level. And the commodity producers, contrary to the last bear market, they're fully under leveraged right now. So they have deleveraged their balance sheet, so they're in a very healthy situation from a balance sheet perspective. So even at lower commodity prices, they would be suffering way less than what they did in the last down cycle.
Okay. Thank you, Thiago, so much
for
your comment.